You're probably aware by now that Social Security is quite literally the largest Ponzi scheme in history. But recently there's been growing pushback, a response to that fact, saying, well, yeah, but really isn't everything a Ponzi scheme? I mean, look at your 401k. The only reason you're able to get more out of your retirement later on is because new investors come in and buy you out. In other words, it's a Ponzi scheme just like Social Security. And what about things like gold or Bitcoin that only go up in price and allow you to cash out later on because new investors are paying you more? And what about insurance even? When you look at health insurance, life insurance, car insurance, the only reason why you are able to have your benefits is because new investors come in and pay you out. Isn't everything in the financial world just a Ponzi scheme? And while this argument can seem quite compelling on the surface, I'm going to show you that it's actually just sleight of hand. There's a true definition of Ponzi scheme, and it truly matters what is and what isn't a Ponzi scheme because Ponzi schemes represent true loss. In other words, they cause harm and damage people, leaving some worse off than they were before. They are immoral, and it is important to know what is one and what is not so that we can try and put an end to the ones that really are. My name is Joe Brown. I'm a former stockbroker and now I run Heresy Financial, where I help active investors decrease portfolio risk and increase long-term returns. Many investors today are banking on the fact that Social Security will be there someday for them when they retire, and therefore they have not invested enough to support themselves. So if Social Security is truly a Ponzi scheme, this matters because many people will not have the amount that they think they will in retirement as a result. So what is a Ponzi scheme? The definition of a Ponzi scheme is a system where earlier participants are paid exclusively using the contributions of later participants with no exchange or production of real value. So first, let's take a look at a recent example of a real-world Ponzi scheme. Many of you are familiar with Bernie Madoff, who is an investor with an amazing skill and track record, so much so that people actually begged to open accounts with him. However, in December of 2008, the truth finally came out that he was actually running a Ponzi scheme. Madoff ended up receiving a 150-year prison sentence for his crimes. Now, this Ponzi scheme was run very similarly to any other simple Ponzi scheme. He went to an investor and said, hey, here are the returns. I'll promise you, let's just say 12%. They would say, that sounds great. Here is my $1 million. So he would say, thank you for your $1 million. And the next year he would pay them out their returns. As the news spread about his very consistent, safe, reliable, high returns, more and more people wanted to invest with him and started writing him checks. As long as more money was coming in than he was paying out in returns to old investors, everything was great. But the key thing is, this money was not being invested and the returns were not actually real. They were just sitting in an account. While he was telling his investors that they were earning 12% or 10% or 20%, it could be anything, the money was actually not doing anything. It was just sitting in the bank. But the investors just didn't care enough to look into it, at least at first, because they were seeing on paper the numbers that they wanted to see. And when they requested withdrawals or requested their payouts, they would get them. The only time it becomes a problem is when too many people want their money back all at once because it's not actually there. This brings us to our second example, which is Social Security, and why people call Social Security a Ponzi scheme, because it operates the exact same way. In fact, if Social Security was run by any company or person other than the government, they would be in jail. It would be shut down. So here's how it works. They first approach the new investors. In this case, it is anybody with a job. And they say, hey, we are going to pay you out in your old age a certain number of dollars per month based on how much money you contribute into this investment fund. Now, the difference here is that they don't actually give you a choice. They're going to take your money no matter what. You don't have the option to just opt out. So they take your money from your paycheck and they say, as a result of that, this is going to be like a pension. We're going to pay you in the future from the returns from the money that you put into the trust fund. The only problem is that's not what's happening. They are taking your money to pay it out to other old people who are currently the beneficiaries. The money is not being invested. There's no real growth and nothing happening with it. Your money is going in and it is going out to pay somebody else. And everybody who is currently getting paid from Social Security was the same exact thing. When they were young and paying into it, they weren't paying into anything. They were paying other old people who are already retired. In other words, the government was stealing money from some people to pay out other people, and now that those people are old, they are demanding that the government keep on stealing money from some people to give to them. And it's not like this is a new problem. You can see the Social Security Administration released this report all the way back in 2010, saying that the Social Security Trust Fund would be empty by 2037. Once that account is empty, they can only pay out what gets paid into it by current employees, which would mean that payouts would be reduced to 76% of what they currently are. And it's not like this problem has gotten better since 2010. That original depletion date of 2037 has only moved closer in time, and now they're estimating a depletion date of around 2032 or 2033. That is only 8 years away. Sometimes things get too abstract when we think about dollars and the digital system and security programs and insurance and benefits. So let me make this very clear what is actually happening by giving you a desert island example. There's 100 people who have been deserted on an island. One person is very old. Regardless of how many seashells and coconuts and fish and tools that old person has stored up, he is collecting fish and coconuts from everybody else who is actually working on the island. In 20 years, when he has gotten old and died, and now somebody else is the oldest on the island, the new person who is the oldest on the island says, hey, when I was young and working, I had to give up some of my coconuts and fish to pay that old guy. Now, because of that, I want you to give up some of your coconuts and fish to pay me, because now I'm the old guy. You may hear this description and think, well, that's perfectly fine. That's the way a social society should work. And that's an argument that can be made. I would disagree with, but you can make that argument. The argument you can't make is that that is fundamentally different than the way Social Security operates today. So now let's take a look at how this differs from 3 other categories that are mostly free market categories. We have investments and assets, we have tools and capital, and we have insurance. First, let's look at investments and assets. Somebody who is trying to convince you that investments and assets are Ponzi schemes will give you the following description. I invest in the stock market by buying shares at a certain price, let's say $100 per share. I grow old, time goes on, 20, 30 years pass, and those shares that I bought have increased in price because new investors have come along and paid more for those shares than I originally paid for them. Now that those shares are worth more because of the new investors, I sell my shares for $500 per share to new contributors or new investors, and I am able to make a living off of the fact that those new investors came in and paid me out more than I contributed. Sounds like a Ponzi scheme, right? Because it relies on new investors putting in more than I did and paying out earlier participants. Here's the real mechanics of what is actually going on with an investment. I am purchasing ownership of a real business, and that real business produces real goods or services. These goods or services are sold or exchanged to customers in a mutually beneficial arrangement. Nobody buys a cell phone unless they want the cell phone more than the money they are giving up. Nobody buys a burger unless they want the burger more than the money they are giving up. So the customer gives up something they want less, which is the money, for something they want more, which is the product. And the company in return gives up something they want less, which is the product, for something they want more, which is the money. These cash flows and these profits are the basis for the value of the business that I own a part of. If, and here's the key, only if the company grows from wealth creation, continuing to expand the products and services that it provides to people in mutually beneficial exchanges, do I benefit by having my slice of ownership of that company grow. There is no guarantee here. If the company does not create more wealth over time, then my company shrinks, which means the size of the slice of the pie that I own actually shrinks as well. In other words, there's real wealth creation going on here as a result of the free market exchange. It's not a zero-sum game. Amazon's market share does not represent the market share that it took from competitors that have gone out of business. It represents mostly market share that was created out of nothing from the value it created that customers are willing to pay for. Apple's market share does not exist solely from market share it took from competitors. It created that market share. This is wealth creation. It is not a zero-sum game. And owning a piece of that means if that wealth creation continues, then your ownership slice increases. If you want a very simple desert island Example of what's going on here. Imagine 100 of us are stranded on a desert island and I want to make a lemonade stand. Unfortunately, this island does not have any lemon trees, but they do have coconut trees. So I'm making a coconut drink stand. Now, as I build this coconut stand, it takes time, it takes labor. I have to go collect coconuts that I don't eat myself, and I have to make drinks with them. I have to make the cups, I have to make the table, I have to put time and resources and labor into making this system that I can then give somebody else something that they want more. In other words, in this case, a cup of coconut water. Now, the cool thing about this is that that person that I sell the coconut water to, they don't have to go collect the coconuts themselves and do all the work that I did. And so because of that, they are willing to give me something in exchange for that so that they don't have to go get the coconuts themselves. In this case, maybe it's fish, and I charge one fish for 5 cups of coconut water. Now, not everybody on the island knows about this, so I have to spend time going around and doing marketing and telling everybody on the island that this exists and convincing people, hey, your life would be a lot easier if you could just focus on doing the thing that you do best, right? Wouldn't you like to focus on just building huts since you're so good at that? Leave the coconut water getting to me. I'm really good at that, and you'll get more coconut water as a result if we participate in this mutually beneficial exchange. Now, there's a kid on the island that doesn't actually have very many skills, and so what I do is I hire him and I say, hey, I will pay you in coconut water if you come and work for me so that I can try and grow this coconut water stand. Now, he's all for this because he doesn't know how to fish. He doesn't know how to get coconuts himself. He doesn't know how to build huts or do anything else on the island, but he still needs a way to provide value so that he can take care of himself. So I give him a job, and he's able to drink some of the coconut water as his payment, and he's happy to do so because along the way, he's also learning how to run the whole coconut stand. Now, over the months and years, I've dialed in this coconut stand to a precise machine, and I know it produces for me 15 fish per day. And I can use those fish to go out on the island and buy things from other people that I want using those fish. And because I've hired a couple of people to run the stand for me, I don't have to do that labor anymore myself. And so I really own a business that is producing cash flow. In this case, the cash is fish. But I'm getting old and I don't want to have to run this coconut stand myself. And so I would like to sell this coconut stand. It is a business now. It produces 15 fish per day. And so I find a few buyers on the island who want to buy that from me and are willing to pay me hundreds of fish and hundreds of coconuts to purchase this because they know it's a well-oiled machine and it's going to provide a return for them on their investment. As a result of my sale of the coconut stand to other island members, I am able to have a payday and I'm able to live the rest of my days in peace without having to run the business myself. Those people that bought the coconut stand may try and grow that business farther and sell it themselves in the future, but the business has value in and of itself because of the wealth it creates and the cash flow and the profits it produces for the owners. That's why they bought it. And it didn't exist before, at least to that extent, which is why I was able to sell it for more than what I bought it for, which was nothing because I created it. In conclusion, investments and assets are not Ponzi schemes because the asset itself produces wealth and ownership of that asset produces profits. Selling that ownership to somebody else relies on that asset being attractive to the buyer, and it only happens if the buyer is sufficiently certain of those future profits continuing. In other words, there's an exchange of real value taking place at the exit. It is not a one-way transfer from one person to the other. They pay me and they receive an asset. Okay, so it's clear now that investments and assets are not Ponzi schemes because they generate real wealth. But what about things like tools? What about things like capital? Examples here that people would use would be things like gold or Bitcoin because they don't produce profits. They're not companies. They don't produce cash flows or real products or services. And you could also throw other forms of capital into this category like equipment like tractors. The person who is trying to convince you that things like this are a Ponzi scheme will say that I buy a yellow metal that is smashed into flat circles. I grow old, that yellow metal increases in price because new buyers of that yellow metal are paying more for it than I paid for it. So I sell my yellow metal to new investors for a higher price than I paid for more than I put in, and I'm able to retire and live on that. Sounds like a Ponzi scheme, right? Because this relies on new investors giving me more than I put in. Here's the real mechanics of what is going on here. I bought a tool or capital. The definition of capital is just something that allows you to get what you want. A mouse can be considered capital, and it can be considered productive capital if I use it for my business to help me make money, or it can be considered consumption capital if I use it to play a video game for enjoyment. It's not the nature inherently of the thing itself that makes it productive or consumption capital. It's the way that you use it. Gold and things like Bitcoin fall into this category as well. Gold is a monetary asset. It is a tool that functions as in the role of money. What does money do? Money stores value and then serves as the medium to exchange that value to somebody else in the future. So something that performs the role of money very poorly would be something like rice. Yes, you can store rice for a while, and the value of that rice is probably not going to fluctuate that much unless there's a big drought and then the rice becomes really valuable, or maybe something happens, a new innovation happens, everybody's able to grow a lot more rice, and so the value would go down. But ultimately, the value of that rice is probably usually not going to fluctuate that much. But the problem is it doesn't last forever. So I can't store that rice for 40 years and then try and sell it later in order to live off of. It has a shelf life. It can get eaten by bugs and by mice. And so while things like rice have been used as money in the past, they never persisted very long as a form of money because of some major flaws. That's why things like gold rose to the top, because it performed that function. It was a tool that was used as money, and it did very, very well. It was easily recognizable. Very, very difficult to make more of, very difficult to fake or forge. It's indestructible, literally lasts forever. You cannot manufacture more of it. You can only dig some out of the ground with time and labor and effort. And so it is a tool that performs the function of serving as money. Now, Bitcoin, whether you like it or not, is also a monetary tool. It is designed to store and transfer value. With a monetary tool, the better it does its job, the more valuable it gets over time, relative to everything else. Take, for example, the dollar. The dollar performs the various functions of money, most of them pretty well. There's liquidity, many people will accept it as payment. Problem is, the supply keeps on increasing, and sometimes erratically and sometimes very quickly. And that supply increase is faster than the increase in the growth of the real goods and services that people want. And so we get inflation, which means the value of the money goes down relative to all the stuff. It takes more dollars to get all the stuff. Something like gold, the supply increases very, very slowly, which means the supply of everything else increases more rapidly. And so the value of that gold relative to everything else actually goes up. It does the opposite of dollars. So far, Bitcoin does the same thing as well. And so with capital, the better they do their job and perform the functions that they're supposed to do, the more valuable they will become. Monetary tools by nature can continue to increase in value in perpetuity because their value is relative to everything else, and we can continue to make more goods and services. If something like a computer were to get better over time, and instead of slowing down, it would get faster over time and the storage would increase over time, then that computer would also get more valuable over time. So with capital/tools, the better they serve their functions, they perform their roles, the more valuable they get over time. For a very simple desert island example of what is going on here, imagine that throughout my years on the island, I make tons of hammers. I make tons of umbrellas. I make tons of spoons and forks and bowls and cups out of coconuts. And some of them I sell to other islanders as time goes on, just so I can have food and survive, but a lot of them I actually store up and I don't get rid of. I keep them. Now, these aren't investments. They're not producing anything for me. They're not a business. There's no cash flow. They're just tools. They are idle capital, not being put to work. But once I get too old and I can no longer perform the functions that I used to, I slowly sell these tools one by one. I sell a hammer here, I sell an umbrella there, and then over time, I am able to continue to make a living as I provide society something that they want in return for something that I want. This is not a Ponzi scheme because the exchange of value is going both ways. I'm not taking from somebody who is younger simply because I'm old. I'm giving somebody else something that they want more than what they're giving up to give me, which means from this exchange, we are both better off. And the only reason I have this capability is because of years of deferred consumption and accumulated capital. In other words, I produced more than I consumed so that I had a surplus to draw on later. Okay, fine, you say. It makes sense that investments and assets that produce cash flow are not Ponzi schemes. It also makes sense that things like gold and accumulated capital over the long term, you selling those are not Ponzi schemes because we've got value going both ways. But what about insurance? The person who's trying to convince you that insurance is a Ponzi scheme, just like Social Security, is going to tell you, number one, you put money into the insurance company, you pay your premium. Number two, you get into an accident or you die or you submit a claim, and then the new contributors pay you out. Sounds like a Ponzi, right? It relies on new buyers giving you more than you paid in. Here are the real mechanics of what is going on with insurance. And I need to make a caveat here. I'm talking only about private free market insurance. This doesn't apply to any insurance product with government involvement. Government involvement usually means that the premiums are a lower cost than they would be otherwise, or the benefits are larger than they would be otherwise, or sometimes a mix of the two. None of the mechanics I'm going to talk about here will work if you do have outside intervention. They only work in a completely free market. So for this example, you're going to have to think of things like jewelry theft insurance. Healthcare doesn't count here. Even auto insurance doesn't count here. Many life insurance products don't count here. Those all have too much government regulation for this to work. With insurance, free market insurance, there is an exchange of value happening at both the purchase and at the payout. These are not one-way transfers. Ponzi schemes have one-way transfers of money going from new contributors out to old participants. With insurance, we have two-way exchanges of value. So first, I pay my insurance premium. What am I getting for that? I am getting a transfer of risk. In other words, if I get my jewelry stolen from me, then I have the risk of that loss, especially if it is expensive jewelry, then I might have risk of really large loss. And so I am paying somebody else for the right to push that loss onto them if something were to happen. In other words, I am exchanging the low probability of really, really large loss for a high probability of a really, really small loss, because I'm guaranteed that I'm going to give up my premiums. $10 a month, $50 a month, whatever it is. Guaranteed I'm giving that up. Small loss. But now I no longer have to risk the potential very large loss of thousands of dollars. The only way this works is if it is priced in a way that is mutually beneficial. Because if the insurance company cannot profit, in other words, the premiums are so low that when there are payouts and claims submitted, it wipes them out and they go bankrupt, well then the insurance company doesn't exist anymore, so I cannot, as a consumer, transfer my risk to somebody anymore. So the price of the premium has to be enough where the insurance company can make a profit so that they can stay in business. That's the only way to ensure that I get what I want, which is to get rid of my risk of large loss. On the other hand, if it is priced so high that I can't afford it, then theoretically, yeah, they would have massive profits. But if people can't actually afford to buy it then again, the consumer doesn't get what they want, which is to transfer that risk. And then if it's priced too high, they don't get what they want either, which is profits so that they can stay in business and enjoy the cash flow. So the pricing on insurance is mutually beneficial so that both parties get what they want. The consumer gets to transfer the risk of loss to the insurance company, and the insurance company gets to profit, even accounting for all the payouts along the way. A very simple desert island example of what's going on here. Let's say half of us on the island are coconut harvesters because we just go through coconuts so much. They got food, they've got water in them, they got electrolytes, fat, they're great. But obviously climbing up coconut trees to gather those coconuts risks falling off that tree, becoming paralyzed, and you can't support yourself anymore. So there's one guy on the island who came up with a great idea to create an insurance product for the coconut collectors. And this is paralyzation insurance. If something happens to you and you fall off the tree, you get paralyzed, then you will get a payout of 4 coconuts a day for the rest of your life. Now, this coconut insurance is cheap. It's only 2 coconuts per week. Over the course of the years, 1 or 2 people do actually end up falling off the trees and becoming paralyzed, but the payments from everybody else who is participating in the insurance program are enough to cover the payouts. And that insurance guy, he can stay in business because there's still a profit after accounting for those payouts. So the insurance guy gets something he wants, which is just constant cash flow of coconuts coming in. And the coconut collectors get something they want, which is the risk of loss is transferred to the insurance guy. They know if they fall off and get paralyzed, they don't have to be worried about starving the rest of their life. In other words, insurance is not a Ponzi scheme because both the risks and the terms of the agreement are known and transparent beforehand. The exchange happens voluntarily and value is being exchanged both ways. In this case, it's money going one direction and risk transfer going the other direction. And both parties voluntarily participate because they are both made better off as a result. Let's go back to the definition of the Ponzi scheme we covered at the beginning of the video. A Ponzi scheme is a system where earlier participants are paid exclusively using the contributions of later participants with no exchange or production of real value. Real investments and assets are not Ponzi schemes because they are ownership in assets that produce real value and profits. Number two, tools and capital are not Ponzi schemes because at the point of sale, value is being exchanged both ways. And it can only happen because of deferred consumption. In other words, production that is larger than consumption. Number three, insurance is not a Ponzi scheme because the terms and the risks are known both ways, and that transfer of risk is made voluntarily on both sides. And as I hope is abundantly clear at this point, Social Security does not fall into any of these three categories. Number one, the transfer is not voluntary, it is forced. Number two, the pricing and the terms are unknown ahead of time. Premiums fluctuate through your life and the payouts are unknown. Number three, no real value is being exchanged as a result of purchasing the premiums for Social Security because it is not an exchange of value. It is a transfer of money from you to somebody else. Number four, there is no investment in any ownership of any asset that produces any real world goods or services or products. As a result, there are no profits and there are no cash flows, which is why Social Security is living on borrowed time and has about 8 years left until it's completely drained. It is the biggest Ponzi scheme in history. But thinking that just because other things might look a little similar on the surface means that those are Ponzi schemes as well will force people to second guess investing, producing more than they consume, deferring consumption, thinking if everything's a Ponzi scheme, then might as well just forget about it and not care. This is wrong. This is dangerous and is leaving so many people woefully unprepared for the point at which they will not be able to rely on the government to support them anymore. Or I should really say rely on the government to take money from other people to support them anymore. But don't worry, it is never too late. If you think you have not saved enough for retirement or your returns are not where you would like them to be, and you would like me to help you apply ideas like this to your investing, click on the link in the description below. As always, thanks so much for watching. Have a great day.